One of the most important steps to polish your finances and avoid debt ceiling disaster is to create a realistic budget and track your expenses. A budget is a plan for how you will spend your money each month. It helps you prioritize your needs and wants, set financial goals, and save for the future. Tracking your expenses is a way of monitoring how well you are sticking to your budget and where you can make adjustments. To create a realistic budget, you need to follow these steps. List all your living expenses. These are the costs that you cannot avoid, such as housing, transportation, health care, utilities, groceries, and child care. You can use your bank statements, receipts, and bills to estimate how much you spend on these categories each month. List your flexible and recurring expenses and loan payments. These are the costs that vary from month to month or that you can control to some extent, such as entertainment, clothing, travel, dining out, subscriptions, credit card payments, and other debt repayments. You could also use your bank statements, receipts, and bills to estimate how much you spend on these categories each month. Add up your after-tax income. This is the amount of money that you take home after taxes and deductions are taken out of your paycheck. You can use your pay stubs or tax returns to calculate this amount. If you have other sources of income, such as interest, dividends, alimony, or child support, include them as well. Set financial goals. These are the things that you want to achieve with your money in the short term or long term, such as saving for an emergency fund, a vacation, a down payment for a house, or retirement. You can use online calculators or apps to figure out how much you need to save for each goal and how long it will take you to reach them. Record and track your spending. This is where you compare your actual spending to your budget and see if you are on track or not. You can use a spreadsheet, a notebook, an app, or a website to record every purchase that you make and categorize it according to your budget. You can also use online tools or apps that link to your bank accounts and credit cards and automatically track your spending for you. Adjust and review your budget for growth. This is where you evaluate your progress and make changes as needed. You should review your budget at least once a month and see if you are meeting your goals or not. If you are spending more than you planned on some categories, you need to find ways to cut back or increase your income. If you are spending less than you planned on some categories, you can allocate more money to your savings or debt repayments. By creating a realistic budget and tracking your expenses, you can avoid overspending and debt and polish your finances for a brighter future. One of the best ways to polish your finances and avoid debt ceiling disaster is to build an emergency fund. An emergency fund is a cash reserve that you set aside for unplanned expenses or financial emergencies, such as car repairs, medical bills, or a loss of income. Having an emergency fund can help you cover these costs without relying on credit cards or loans, which can lead to debt and interest charges. It can also reduce your financial stress and help you achieve your larger savings goals. But how do you build an emergency fund? Here are some steps you can follow. Make a budget and see where you can save more money. A budget is a plan that shows how much money you earn and spend each month. By tracking your income and expenses, you can identify where you can cut back on unnecessary spending and free up some money for your emergency fund. For example, you can save money by eating out less, canceling unused subscriptions, or switching to a cheaper phone plan. Determine your emergency fund goal. The amount you need to have in your emergency fund depends on your situation and expenses. A common rule of thumb is to have 3 to 6 months' worth of household expenses in your emergency fund. This can help you cover your basic needs if you lose your job or have a major emergency. However, you can start with a smaller goal, such as $500 or $1,000, and work your way up gradually. Set up a direct deposit or automatic transfer to your emergency fund. One of the easiest ways to build your emergency fund is to automate your savings. You can set up a direct deposit from your paycheck or an automatic transfer from your checking account to a separate savings account for your emergency fund. This way, you don't have to remember to save every month, and you can avoid the temptation to spend the money on something else. Gradually increase your savings rate. As you get used to saving for your emergency fund, you can challenge yourself to save more over time. You can increase your savings rate by a small percentage every month or every quarter, or whenever you get a raise or a bonus. For example, if you save 10% of your income for your emergency fund, you can try to increase it to 11% next month, then 12% the following month, and so on. Save unexpected income. Another way to boost your emergency fund is to save any extra money that comes your way unexpectedly. This could be a tax refund, a stimulus check, a gift, or a cashback reward. Instead of spending this money on something else, you can use it to grow your emergency fund faster. Keep saving after reaching your goal. Once you reach your emergency fund goal, don't stop saving. You can use the money that you were saving for your emergency fund to pursue other financial goals, such as paying off debt, saving for retirement, or saving for a vacation. You could also continue to add money to your emergency fund periodically to keep up with inflation and rising costs. Use a bank account bonus to jumpstart your savings. Some banks offer sign-up bonuses for opening a new savings account and meeting certain requirements, such as maintaining a minimum balance or making a certain number of deposits within a specified period of time. You can take advantage of these offers to get some extra cash for your emergency fund. Where should you keep your emergency fund? The best place to keep your emergency fund is in a safe and accessible account that earns some interest, but does not charge fees or penalties for withdrawals. Some examples are a high-yield savings account. This is a type of savings account that offers a higher interest rate than a regular savings account. It usually has no monthly fees or minimum balance requirements and allows easy access to your money through online banking or ATM withdrawals. A money market account. This is a type of savings account that also offers a higher interest rate than a regular savings account, but may have some restrictions on the number of transactions or withdrawals per month. It may also require a higher minimum balance than a high-yield savings account. A certificate of deposit, CD. This is a type of savings account that offers a fixed interest rate for a fixed term, such as 6 months or 1 year. It usually has no monthly fees, but may charge a penalty for early withdrawal before the term ends. When should you use your emergency fund? You should use your emergency fund only for true emergencies that are urgent, necessary, and unexpected. Some examples are a medical emergency that requires immediate attention and is not covered by insurance, a car breakdown that prevents you from getting to work or school, a home repair that affects the safety or functionality of your house, a job loss that leaves you without income for an extended period of time. You should not use your emergency fund for non-emergencies that are not urgent, necessary, or unexpected. Some examples are a vacation that you want to take but did not plan for, a new gadget that you want to buy but do not need, a birthday gift that you forgot to budget for, a credit card bill that you could have avoided by spending less. If you use your emergency fund for an emergency, make sure to replenish it as soon as possible by following the steps above. Building an emergency fund may seem daunting at first, but it is one of the most important steps you can take to polish your finances and avoid debt ceiling disaster. By following these steps and saving consistently, you can create a safety net that will protect you from financial shocks and help you achieve financial peace of mind. Insurance is an essential part of your financial plan. but it can also be confusing and overwhelming. That's why it's important to review your insurance policies regularly and make sure you have adequate coverage for your personal and business needs. In this section, we will show you how to review your insurance policies and what to look for when you do. We will focus on 4 types of insurance: health, life, disability, and property and casualty. Health insurance. Health insurance covers your medical expenses in case you get sick or injured. You should review your health insurance policy at least once a year, especially during open enrollment periods when you can change your plan or provider. Here are some things to check when you review your health insurance policy. The premium. This is the amount you pay every month for your coverage. Compare your premium with other plans or providers and see if you can save money by switching or adjusting your coverage level. The deductible. This is the amount you pay out of pocket before your insurance kicks in. A higher deductible means a lower premium, but also more risk. Make sure you can afford your deductible in case of an emergency. The copayments and coinsurance. These are the amounts you pay for each service or visit. Copayments are fixed fees, while coinsurance is a percentage of the cost. Look for plans that have lower copayments and coinsurance for the services you use most often. The network. This is the group of providers that accept your insurance. Check if your preferred doctors, hospitals, and pharmacies are in your network and how much they charge. If you go out of network, you may pay more or get no coverage at all. The benefits. These are the services and treatments that your insurance covers. Review your benefits and see if they match your needs and preferences. For example, do you need prescription drugs, mental health services, dental care, vision care, or preventive care? If not, you may be able to lower your premium by choosing a plan that excludes them. Life insurance. Life insurance pays a lump sum to your beneficiaries in case you die. You should review your life insurance policy every 3 to 5 years or whenever you have a major life change, such as getting married, having a child, buying a house, or starting a business. Here are some things to check when you review your life insurance policy. The type of policy. There are 2 main types of life insurance: term and permanent. Term life insurance covers you for a specific period of time, usually 10 to 30 years. Permanent life insurance covers you for your entire life and has a cash value component that grows over time. Term life insurance is cheaper and simpler than permanent life insurance, but it expires when the term ends. Permanent life insurance is more expensive and complex than term life insurance, but it lasts as long as you pay the premiums and can provide additional benefits. The amount of coverage. This is the amount that your policy pays to your beneficiaries when you die. You should have enough coverage to replace your income and cover your debts and expenses for your dependents. A common rule of thumb is to have 10 times your annual income in coverage, but this may vary depending on your situation. The beneficiaries. These are the people who receive the money from your policy when you die. You should name at least one primary beneficiary and one contingent beneficiary in case the primary one dies before you. You should also update your beneficiaries whenever you have a change in your family or relationship status. The premium. This is the amount you pay every month or year for your policy. Compare your premium with other policies or providers and see if you can get a better deal or more coverage for the same price. The cash value. This is the amount that accumulates in your permanent life insurance policy over time. You can borrow against it or withdraw it for any purpose, but this will reduce your death benefit and may incur fees or taxes. Check how much cash value you have and how it grows over time. Disability insurance. Disability insurance pays a portion of your income if you become unable to work due to an illness or injury. You should review your disability insurance policy every 3 to 5 years, or whenever you have a change in your income or occupation. Here are some things to check when you review your disability insurance policy. The definition of disability. This is how your policy determines if you are eligible for benefits. Some policies use an own occupation definition, which means you are disabled if you cannot perform the duties of your specific job. Other policies use an any occupation definition, which means you are disabled if you cannot perform any job suitable for your education and experience. Own occupation policies are more generous and expensive than any occupation policies. The elimination period. This is the waiting period between the onset of disability and the start of benefits. It can range from 30 days to 2 years, depending on your policy. A longer elimination period means a lower premium, but also a longer gap in income. The benefit period. This is the duration of benefits once they begin. It can range from 2 years to lifetime, depending on your policy. A longer benefit period means a higher premium, but also more protection. The benefit amount. This is the percentage of your income that your policy replaces when you are disabled. It can range from 50% to 80%, depending on your policy and other sources of income, such as Social Security or workers' compensation. You should have enough coverage to maintain your standard of living without depleting your savings. The riders. These are optional features that enhance or modify your policy. Some common riders are cost of living adjustment, COLA, which increases your benefit amount with inflation, future purchase option, FPO, which allows you to increase your coverage without medical underwriting, residual benefit, which pays partial benefits if you can work part-time, and waiver of premium, which waives your premium while you are receiving benefits. Property and casualty insurance. Property and casualty insurance covers your belongings and liabilities in case of damage, theft, or lawsuit. It includes homeowners, renters, auto, umbrella, and business insurance policies. You should review these policies at least once a year or whenever you have a change in your assets or liabilities. Here are some things to check when you review these policies. The coverage limits. These are the maximum amounts that your policy will pay for each type of loss or claim. You should have enough coverage to replace or repair your property or cover any legal judgments against you. The deductibles. These are the amounts that you pay out of pocket before your policy pays anything. A higher deductible means a lower premium, but also more risk. Make sure you can afford your deductible in case of a claim. The exclusions. These are the situations or events that are not covered by your policy. For example, most homeowners' policies do not cover flood, earthquake, mold, or wear and tear damage. You may need to buy additional policies or riders to cover these risks. The discounts. These are the reductions in premium that you may qualify for based on certain factors or behaviors. For example, some auto insurers offer discounts for safe driving, low mileage, anti-theft devices, or bundling with other policies.